Okay, so for today's deep dive, we're looking at a January 28, 2026 equity research report on JPMorgan Chase.
Right.
And the big takeaway here, it seems, isn't really about banking. The analysts are calling JPM a macroeconomic proxy.
It's a huge claim. But when you look at the scale, it makes sense. I mean, they're basically saying that at this point, JPM is the sector.
The apex of the global financial hierarchy, I think was the phrase they used.
That's the one. But here's the dilemma for you as an investor. The stock is trading at $301.04. It's expensive.
Yeah, that's a massive premium. So the mission here is to unpack why analysts are slapping a BUY rating on it. Is the Fortress balance sheet really worth that kind of money?
That's the whole debate. If you look at the 2025 numbers,
Right.
we're talking $57 billion in net income,
Wow.
which is driving an 18% return on tangible common equity. I mean, for a bank of that size to generate those returns it's just incredible.
And this is happening in a pretty volatile environment. The report gets into this shock absorber model JPM has.
It's basically an internal hedge. So when rates were high, the commercial bank was the engine. Now the Fed is projected to cut rates down to, 3.5% by the end of 26?
Which you'd think would hurt them. You'd expect margin compression.
Usually, yeah. Lower rates typically hurt a bank's core lending business. But for JPM, that's the trigger for the investment bank to fire up.
So M&A, IPOs, all that activity comes roaring back.
Exactly. One side cools down, the other heats up. They're built to capture the upside either way.
Okay, but every big bank tries to do that. The report seems to argue what sets JPM apart is just brute force spending.
It's the $17 billion a year they're spending on tech. It's not just an expense, it's a weapon.
A wide moat made of cash.
It is. The regional banks just can't compete. And we're not just talking about keeping servers running. They're implementing AI at an industrial scale.
Right, the precision strategy. The report notes they've doubled productivity gains from 3% to 6% in some divisions just with AI.
And they're rolling out Index GPT to their wealth management clients. It's a tech arms race, and they're winning.
Well, let's pivot to the aggressive move they made in January. They didn't just build tech, they bought a huge tech-forward portfolio, the Apple Card.
This is the big catalyst everyone is watching. JPM took that whole portfolio off Goldman Sachs' hands.
And we're talking, around $20 billion in loans?
About that, yeah, and 12 million customers.
Which is so interesting because Goldman famously couldn't make it profitable. So why does JPM think they can?
Because I don't think they see it as just a credit card. It's a customer acquisition strategy. It's a checkmate move against Fintech.
So you combine JPM's balance sheet with Apple's distribution.
Exactly. You get direct access to 12 million millennial and Gen Z users, people they can then upsell a mortgage to or wealth management down the line.
It wasn't a free lunch, though. They had to take a massive provision to absorb it, right?
They did. A $2.2 billion provision for credit losses in the fourth quarter of 2025. But you have to see that as the cost of admission. The price of buying market share.
Okay, so it's not the only friction point. The report is clear that 2026 has some unique headaches.
The political landscape, you mean? Yeah, you can't ignore that.
We have to mention it. In January 2026, former President Trump filed a $5 billion lawsuit alleging political debanking. Now, we're not touching the legal merits here.
Of course not.
But from an investment perspective, that is real headline risk. It puts a target on your back.
It invites scrutiny, absolutely. And that's sitting right alongside the whole Basel III endgame regulation. New capital requirements are coming.
Which could force them to hold more cash instead of, say, buying back stock.
Right. And then there's the leadership transition. Daniel Pinto, the president and COO, is retiring.
And Jennifer Piepszak is stepping into that COO role. So she's now the clear frontrunner to succeed Jamie Dimon whenever he decides to step down.
And speaking of Dimon, the report flags that he sold stock in February of 25 and then again in February of 26.
Now, they say it's just estate planning, standard stuff.
Which it probably is. But, anytime a CEO sells stock at an all-time high, investors, they get a little twitchy.
So you put it all together, the political heat, the valuation, the leadership shuffle. What's the final verdict from the analysts?
The argument is you're paying for quality. It trades at 2.29 times book value, which is rich, no question. But in a shaky economy, JPM actually benefits when weaker competitors get into trouble.
A flight to safety.
A flight to safety, but one that still has growth. They see about 11.7% implied upside from the current price. It's a defensive growth play.
So the takeaway is, if you want stability and can stomach the premium, it's an attractive place to be.
That seems to be the consensus.
It does leave us with a bigger question, though, about the whole industry. With this Apple Card deal, you have to wonder if JPM just proved the fintech revolution has a ceiling. Can the disruptors ever really win? Or will the old guard with the massive balance sheets just wait them out and swallow them whole?